Okay, let's unpack this. You probably see luxury watches as symbols of status, intricate craftsmanship, or maybe just really expensive accessories. But what if I told you that the right timepiece, chosen wisely, can actually be a smart, lucrative investment, appreciating in value over time?
That's exactly right. Our mission today is to cut through the glittering surface of the luxury watch market in 2025. We'll be diving deep into insights from watch experts, yeah, including those from New Bond Street
Right.
pawnbrokers.
Hey.
We're extracting the most important nuggets of knowledge to help you understand what's truly valuable, what's trending, and, well, why these intricate machines matter beyond just telling time.
Yeah, and we've got a stack of fascinating sources here. Covers everything from global market trends, specific brand performance, to the often overlooked factors that really make a watch a good investment. Think of this deep dive as your shortcut to being well informed about horological assets, whether you're a seasoned collector or just starting to look at watches through an investor's lens. So when you think of a luxury mechanical watch, you instantly picture like unparalleled quality, exquisite craftsmanship. But for the savvy buyer, it's also a potential gold mine. Our sources reveal that limited edition or specialty watches can actually double, maybe even treble in value once their production stops. The real art, of course, is knowing which ones will achieve that status.
Indeed. And the global luxury watch market. It's already a colossal enterprise, valued at nearly $50 billion. Projections suggest it could surge to $75 billion by 2032. However, it hasn't been a smooth ride recently, has it? What we found particularly fascinating is how prices just escalated dramatically during COVID-19. You had increased capital, fewer discretionary spending options, and demand far, far outstripping supply. This led to an unprecedented ascent, only to be followed by an equally sharp, maybe even painful correction.
And when we say sharp correction, we mean sharp. Here's where it gets really interesting. According to the Bloomberg Subdial Market Index, which meticulously tracks 50 of the most traded luxury watches, the market actually plummeted by a staggering 48% in a mere 24 months. That's a huge drop. It certainly shook a lot of confidence, right?
It absolutely did, and for good reason. Many investors were left, well, overexposed in what became a rather challenging market. However, for anyone considering investing in wristwatches in 2025, there's a significant shift. Between February 2023 and February 2025, those losses slowed to approximately 7%. It appears the market has begun to sort of bottom out, suggesting a period of much-needed stability or maybe even recovery.
Bottomed out. That's a strong statement and certainly an encouraging one for prospective investors. But what specific indicators are giving experts this confidence that we've, seen the worst? And where should our listeners still exercise caution?
That's a crucial distinction. The slowing rate of decline, that's the primary indicator. It suggests the initial shock has been absorbed and supply-demand dynamics are recalibrating. However, and this is vital, it's crucial to note that this bounce back hasn't been uniform, not across all brands or models. Certain highly sought-after pieces are showing early signs of recovery, sure, while others continue to lag. It's a return to discernment rather than, a rising tide lifting all boats. So after that rather turbulent period, there are genuine signs of positivity emerging for 2025. Let's really dig into three key reasons why the outlook is improving for those looking to invest in luxury watches.
Okay, first up, it's all about evolving sentiment and what our sources are calling a redefinition of value. Austin Chu, the CEO of WristCheck, highlighted this in a New Yorker interview. He said last year, everyone was just offloading the hot models. The ones, the usual suspects like Rolex Submariners, AP Royal Oaks, Patek Nautiluses. But now, he says brands like Omega and Cartier are redefining what it means for a brand to hold value in 2025. So what does this shift mean strategically for you, our listener?
Well, this isn't just a fleeting trend. It feels like a strategic signal. Our experts suggest that savvy investors are now looking beyond the established safe bets. They're looking at brands like Omega and Cartier, where the current market reevaluation offers unique entry points for future appreciation. It means diversifying your gaze beyond the usual suspects isn't just an option, it's becoming an imperative, really. These brands are offering robust value and craftsmanship without maybe the inflated premiums we've seen elsewhere.
Fascinating. So the old guard isn't the only guard anymore. Okay, secondly, our sources point to Asia as a critical engine for market growth. Mainland China and Hong Kong are already the biggest importers of Swiss watches, importing over $5 billion last year alone. We often hear about economic downturns affecting luxury markets, but Deloitte's Karine Segedi posits that market turmoil like the 2023 Evergrande collapse and property crisis could actually increase luxury watch investments in the region. How does that work? Precisely. It seems counterintuitive, right? But high net worth investors in Asia are actively seeking alternative assets. tangible assets to protect their wealth during periods of uncertainty. Watches, with their tangible value and historical appreciation, fit this need perfectly. And we certainly can't overlook India. 3 in 4 industry executives are predicting strong growth there. If we connect this to the bigger picture, Asia truly could be the dominant force driving market recovery and expansion.
Right. And for a third reason, interest rate drops. This has been a huge discussion point in all investment circles, hasn't it? Affecting everything from mortgages to stock portfolios. While the Bank of England suggests rates might stay around 5.25% until autumn 2025, the U.S. Federal Reserve is expecting to make 3 rate cuts in 2025. For watch investors, this is absolutely critical. How do these big macroeconomic shifts translate into opportunities for someone looking to buy a luxury watch right now? Well, a more accommodating monetary policy, which lower interest rates signal, directly translates to increased consumer confidence and more accessible capital. For the luxury market, this means an uptick in discretionary spending and, crucially, a higher likelihood of luxury watch purchases. So, for the savvy investor, those current prices we mentioned earlier, they could represent a significant opportunity to buy at a discount before the market potentially fully recovers in response to these rate cuts. It's about recognizing that window of opportunity. Okay, now let's dive into the really fascinating world of specific brands and models, the ones our sources highlight as strong investment contenders for 2025. We'll start with the titans of the industry and then maybe explore some compelling challengers.
First, Patek Philippe. A name synonymous with, well, unparalleled craftsmanship and heritage, always at the top of the list for connoisseurs. Known for its understated style, exquisite design, and every single component being handmade. And digging into our sources, we found this incredible fact. A Patek Philippe, the Henry Graves super complication, once sold for an astonishing $24 million, holding the record for the most expensive watch at auction as of 2025. Just incredible.
It is, and a remarkable aspect of Patek Philippe is their dedication to history. Each watch's journey is meticulously recorded in the brand's archives. You might even find your watch was owned by someone famous, which, as you can imagine, greatly enhances its value. Take the Nautilus Ref 5711, for example. This continued in 2021 and saw a 61% value increase. And a limited edition Tiffany & Co. Nautilus, sold for around £4.87 million.
Wow. But even Patek hasn't been immune to market challenges, right? Our sources show secondary market prices for certain Pateks fell from $170,000 down to $145,000 in 2023. However, early 2025 has seen losses stemmed, with the Nautilus 57111R already bouncing back 10%. So, for our listener, is Patek still the undisputed king, or is its crown slipping just slightly amidst this volatility?
Patek Philippe remains a titan. Definitely. The recent bounce back, particularly with models like the 57111R, it just reaffirms its long-term investment strength. While there was a correction, the market quickly recognized the intrinsic value and scarcity. It's less about a slipping crown and more about a market recalibrating, still placing immense value on its legacy and craftsmanship, but perhaps with a closer eye on specific models and their supply. It's certainly a buy and hold rather than a quick flip, I'd say.
Makes sense. Okay, next up, Rolex. Often seen as one of the safest investments due to its timeless appeal and just universal recognition. The Daytona, for example, has seen its value increase by 37% over recent years and remains incredibly hard to find. The stainless steel version is still a top pick for 2025, according to our sources.
Rolex is truly in a league of its own for consistent demand. They're known for iconic models like the Deep Sea, waterproof to an incredible 1.2 kilometers, and the Submariner, famously associated with James Bond, capable of diving to 1,000 feet. Despite a nearly 8% drop in average prices in 2023, experts predict stability for Rolex moving forward. Interestingly, while some GMT masters saw declines, the Pepsi 126710 BLRO is actually up about 5%, so mixed signals there too.
Right, so for the everyday investor maybe looking for a reliable luxury asset, is Rolex still the absolute go-to for a buy and hold strategy? Or are we seeing signs that even its steadfast performance might require more careful model selection these days?
It remains a strong buy and hold, but with that caveat of model selection. The enduring appeal of Rolex ensures consistent demand, especially for sports models. That slight dip, it was part of the broader market correction, and its recovery is a testament to its resilience. It's really about understanding the specific model's rarity and desirability rather than a blanket assumption that any Rolex is a guaranteed quick win.
Okay, got it. Now, Audemars Piguet, founded way back in 1875, a true innovator, credited with introducing the minute repeater and the world's first skeleton watch. The Royal Oak Automatic, with its timeless octagonal case and reliable 3D-120 caliber movement, is an absolute collector favorite.
Absolutely. And what's particularly significant for investors right now is that the discontinuation of certain Royal Oak models in 2022 means pieces like the Royal Oak 152 over 2 ST Jumbo. They're expected to skyrocket in value. We've already seen a retiring version sell for over £2.523 million. That's huge. While 2023 saw average prices drop about 15% across the brand, long-term demand remains exceptionally firm. You can see that clearly evidenced by consistent global Google searches for the brand. People are still looking.
So with that 15% average price drop in 2023, how should a prospective investor balance that recent downturn with the, long-term historical demand and the clear appreciation potential for discontinued models? Is it more of a risk or an opportunity at this point?
That's a great question. It's an interesting dynamic, isn't it? Where the short-term market correction offers a potential entry point for a longer-term play. The brand's innovation, combined with strategic scarcity around discontinued models, creates strong future demand. Those declines in 2023, they represent a chance, potentially, to acquire a piece of horological history at a more reasonable price, especially for iconic models whose value is poised to rebound and appreciate significantly over the next few years. It's about patience and foresight.
Right, foresight. Now here's an outlier, Richard Mille. Founded in just 1999, but has become legendary in a remarkably short time. Their distinct tonneau-shaped, often skeletonized cases are instantly recognizable. You see them on the wrists of stars like Rafael Nadal and Natalie Portman.
Yeah, what makes Richard Mille such a strong, albeit very high-end investment is their incredibly limited production, only about 5,000 watches annually. Compare that to tens of thousands from other major brands. This scarcity is a powerful driver of value.
Yeah.
They've been one of the best watches to hold value, even during the recent market correction. For instance, an RM52 Tourbillon Skull Asia edition, one of only 6 made, sold for £346,000 back in 2015. Today, it would be worth over £500,000.
Given that astronomical price point and the limited production, who is the ideal investor for Richard Mille, and what kind of risk-reward profile does it represent compared to, say, a Patek Philippe? It feels like a different game.
It is a different game. Richard Mille appeals to a very specific high-net-worth investor, someone who values extreme exclusivity, cutting-edge engineering, and a very distinct aesthetic. The risk is the initial capital outlay, which is, well, substantial. But the reward is exceptional value retention and often significant appreciation due to that extreme scarcity and high demand from a dedicated collector base. It's less about traditional horological heritage and more about avant-garde luxury and performance.
Okay, different niche entirely. Now, Vacheron Constantin holds the title of the world's oldest watch manufacturer in continuous production since 1755. Their design and heritage are comparable to Patek Philippe, yet our sources indicate they're often overlooked by newer collectors. This, it seems, could be a genuine hidden gem for you, the listener.
Precisely. And it raises an interesting question. Why do these brands, with comparable quality to Patek Philippe, often fly under the radar for new collectors? And how long can that last? Prices for vintage examples are often less than half of a similar quality Patek Philippe. We fully expect demand to increase as more collectors recognize the brand's immense value and historical significance. Despite a 7% market decline in 2023, more accessible models like the 56 have actually bucked the trend and are growing. With only about 20,000 produced each year, prices are likely to bounce back robustly.
It sounds like an exciting opportunity, yeah. For someone looking to get into a top-tier brand without that immediate Patek premium. Beyond these 5 titans, our sources highlight several other intriguing brands that could be considered smart diversification plays for 2025. What else should people keep an eye on?
Indeed, there's a whole range. These often represent a blend of enduring quality, specific collector niches, or emerging value. For instance, you have heritage brands like Breguet and A. Lange & Söhne. They represent traditional haute horlogerie, where select, often more complex, models are seeing renewed interest. Then you have consistent performers, like Jaeger-LeCoultre, which actually increased in price in 2023, interestingly, and Omega. Omega offers robust, recognizable quality with reliable, albeit often slower, growth trajectories, especially models like the Seamaster. These are less about quick flips and more about solid, long-term value.
So we're talking about a broader spectrum of investment philosophies then, not just chasing the hottest trends.
Exactly. And for those looking even further afield, brands like IWC and Panerai appeal to specific aesthetics and engineering preferences, with certain iconic lines demonstrating strong demand. Then there are the ultra-exclusive independent watchmakers like de Bethune, producing only 150-300 watches a year. That creates immediate scarcity and collector frenzy for their highly distinctive pieces. And let's not forget Tag Heuer. Each offers a different entry point and potential for appreciation, reminding us that the market is much richer than just a few household names. Now, moving beyond the prestige of the manufacturer and the allure of a specific model, several other crucial factors dictate a luxury watch's true investment value. Overlooking these can be a very, very expensive mistake.
Yeah, naturally, conditions everything, right? Most buyers want near mint. But here's the surprising twist our sources uncovered. Sometimes imperfections aren't a bad thing. They mentioned Paul Newman's Rolex Daytona. It was scratched, damaged even. But those imperfections told a unique story, the story of its famous owner, and they didn't deter its value. In fact, it became the most expensive watch of its time at auction. Isn't that wild?
It is wild, and it's a fantastic point about the narrative a watch can carry, elevating it beyond mere mechanics. Beyond condition, age, and rarity also play a significant role, balancing a watch's physical state with its historical significance, like an original Audemars Piguet minute repeater. Then there's provenance, the full history of ownership and care, the original presentation box, bill of sale, servicing papers, warranty cards, serial number tags, even the polishing cloths. All of these original materials boost value substantially. And of course, the materials themselves, gold, platinum, precious gems, they add inherent worth. Even if a watch is beyond repair, its internal parts can still be valuable as salvage for other restorations. And finally, always verify authenticity. Fakes are unfortunately common, making expert assessment absolutely vital. Understanding these intrinsic values is paramount. But a watch's journey is also profoundly shaped by external forces. And sometimes those forces are global, dramatic, and completely unforeseen.
That's a perfect segue, actually, because our sources show how global events, seemingly distant and unrelated, can profoundly impact this niche market. Let's look at how the Russia-Ukraine war, for example, had a fascinating and, well, complex ripple effect on luxury watch investments.
Yeah, it's quite a story. Following sanctions against Russia and the ruble's significant drop, wealthy Russians began urgently investing in luxury watches to protect their savings. In March 2022, sales in Russian luxury watch stores just spiked dramatically. Watches became a tangible haven during extreme economic uncertainty, especially as cash movement across borders was heavily limited.
This presented a really complex situation for luxury brands, ethically and commercially. Apple, for instance, stopped selling in Russia altogether. Bulgari, however, remained and actually saw increased sales, reportedly due to this surge in domestic demand. We also saw Watches of Switzerland, a major retailer, step down from the Responsible Jewelry Council when it failed to sever ties with Russia, which meant major brands like Rolex, Patek Philippe, and Omega were no longer available for first-hand sales in Russia, further altering market dynamics. And just to be clear, we're simply reporting on these market dynamics from our sources, not endorsing any political stances.
Right, the fallout was swift and dramatic on Russia's secondary market. Well-known watches were fetching 3 times or even more their original price, just incredible premiums. Some Russians attempted to buy outside the country, but stores like Harrods implemented strict spending limits to prevent potential black market sales. Interestingly, luxury watch theft also reportedly rose in Europe, with some sources indicating Russians were among the buyers of these stolen watches. A really murky situation.
Meanwhile, globally, demand for luxury watches far outstripped supply. And this wasn't limited to just Rolex, AP, and Patek anymore. It spread to brands like Zenith, Omega, and IWC. Stores like Watches of Switzerland saw huge revenue increases. A staggering 75% of sales were waitlist orders. The luxury watch index was even up an incredible 32% in 1 year, outperforming vintage cars, gold, and even crypto at the time.
However, as global crypto values and equities have since, well, tumbled, secondary market prices for luxury watches have started to fall again, correcting some of that extreme overvaluation. Without the significant presence of Russian and Chinese buyers, who are both major drivers of demand, prices reportedly dropped an estimated 25% from their peak. It's a clear and powerful example of how interconnected global finance, geopolitical stability, and consumer sentiment truly are, even in the most specialized luxury markets.
Wow, what a deep dive indeed. We've uncovered that while luxury watch investment is complex, and subject to global forces, it's also full of potential. For those who understand the nuances, the market seems to be stabilizing. Asia is clearly a powerful force for growth. Interest rates are a critical factor to watch. And valuing a watch goes far beyond just its brand name. Its story, condition, and provenance are equally vital.
Absolutely. And thinking back to that Paul Newman Daytona, where the imperfections actually added to its legend rather than detracting from its value, it raises an important question for you, our listener. In a world of increasing standardization and, digital information, could a watch's unique story, its history, or even its flaws become the ultimate ultimate mark of its investment potential, a
Mhm.
truly irreplaceable asset. What kind of narrative are you looking for in your next timepiece, whether your goal is passion, profit, or perhaps a blend of both?
Something to mull over as you explore the fascinating world of horological assets. We really hope this deep dive helps you navigate it with a bit more confidence and clarity. Until next time, keep learning, keep discovering.